So good morning, everybody. This is week 5, the end of week 5 here for Financial Foundations class. We spent most of Tuesday talking about credit cards, what to do, how to deal with credit. Today we're going to get more into banking, things to look for, plus a good segment to start off with, I think, is inflation. Anybody familiar with the term CPI? Do you know that acronym? Well, good. If you don't, then we'll figure out what that is today, what it means to us individually or to our families. And I'll give you a clue right now. It's got something to do with inflation. And it's a way that government measures inflation. You know, people like to see a little bit of inflation, but not a tremendous amount. There are 2 different inflation documents in your classwork folder, only because it was a 2-page thing that I just scanned it separately and put it in as individual pages. So right towards the end of this first paragraph, you see that acronym CPI, Consumer Price Index. It's an index that government uses to study how much costs have increased over time. The measurement year is 1982. So you take prices from 1982, indexed against their current prices. You see the last sentence there, it says you divide the CPI, you take the beginning price level and then multiplying the result by 100. There's a price index. So what number, you know, if something cost $20 in 1982 and now it costs 100, that's going to have a fairly large CPI number to it. CPI is important for us as individuals for a couple of reasons. One, if it gets too high, if the consumer price index is showing that inflation is too high, then our dollars aren't going to go as far, and that's not good. The other reason it's important is if you are, let's say you're in a company that's considering giving you an annual raise of 3% and inflation is 5%, that's not going to be good, because now your raise is not keeping up with inflation. So not only do your dollars buy you less, but you don't have as many of them as if you had gotten an increase that would match the inflation rate. You know, you want to be at least keeping up with inflation. So there's several different reasons why inflation occurs in the economy. A lot of times it's about shortages. Think about our supply and demand relationship. If you have a shortage of something that's very, very much needed, a shortage is going to cause the price to go up. A big reason, though, is the deficit of the federal government. Think about all the money that's being borrowed to pay for the interest on the federal deficit. That sort of takes money out of the potentially out of circulation that other people could use for other purposes. The third reason that they're listing here is about labor rates. my example for the family that's only getting a 3% raise is a perfect representation of that. If you're in a union, for instance, and your union contract says that your rates are going to stay equal or above the inflation rate, any increases, then those are labor rates that are going to go up. The wages are going up. So the cost to do business has now gone up for the companies. So when labor costs go up, that could be another reason that you can have inflation. The fourth reason is when the Fed puts too much money in the economy. Now there's too much money in circulation. The dollar is devalued at that point. The biggest effect right there at the beginning of the next paragraph, decreased purchasing power. The dollar's depreciated. You can't buy as much. And who's that going to hurt the most? Look at that second sentence there in the last paragraph. It's especially hard on retired people with fixed incomes. Can also have a disproportionate effect on people in poverty. You know, what little money that they do have doesn't go as far. So inflation is not a desirable thing for individuals or for the economy as a whole. The second page of that particular handout, pause here for a minute and pull that up. The second page of that handout is inflation P2 in your materials. Talks about all the things that go into creating the CPI. There is a federal agency called the Bureau of Labor and Statistics. And that's what those people do. They crunch numbers. They look at the cost of stuff. It's important not only for individuals, but it's important for government too, because if you think about all the government programs where benefits are given out, inflation has an effect on those too. So if inflation rises and then people can't buy as much with their government assistance, then the assistance probably is going to have to go up also. So it's not only an effect on individuals, but it is for the country as a whole. All kinds of stuff is looked at, 200 plus categories. Government charged user fees, water and sewer charges are in there, that sort of thing. This little skinny paragraph, the CPI does not include investment items such as stocks, bonds, real estate, and life insurance. Okay, well, that's because those all relate to savings, not consumption expenses. Because what the CPI is looking at is how much the stuff costs, and it's all about the consumables, things that we buy and consume, and then we have to go buy them again, typically. So if you hear them on the news talking about the CPI, that's what's behind it. If you're thinking about negotiating with your employer for a raise, might be good to know what the CPI is. And that gives you a little bit more, maybe some leverage to say, hey, you know, the CPI is 3.5% right now. Can I get a 3.5% raise or 4%? Not a 2%. You know, 2%, you're falling behind. All right, the next thing we're going to look at here is another one of our Mr. Clifford videos.
Hey, how you doing, Econ students? This is Mr. Clifford. Welcome to Econ Movies. Today we're going to look at the economics in the movie Back to the Future. movie, Marty McFly travels through time to visit 1955, 1985, and 2015.
Are you telling me you built a time machine out of a DeLorean?
And the more things change, the more things stay the same.
What are you looking at, butthead? What are you looking at, butthead?
Must be rough being named after a complete butthead.
Economically speaking, 1955 was very similar to 1985. Now, before we go any further, keep in mind that every economy has three goals. They want to grow over time, they want to keep unemployment down, and they want to keep prices stable. So let's look at the US economy back in 1955.
Go.
1955 was a great year for the US economy. There was growth, prosperity, and a 7% increase in gross domestic product. But don't assume that everything was perfect. Remember, the GDP only shows how the economy is doing. It doesn't tell us anything about other important issues like racial equality, which sucked back then.
Mayor. Now that's a good idea. I could run for mayor.
Colored mayor, that'll be the day.
Well, what about 1985?
Don't take fame. Don't need a credit card to ride this train.
The US economy in 1985 was also going super strong and recovering from a recession. The GDP growth rate was about 4%. But the problem was the clothing. Tucking in your shirt in your jeans with suspenders. Ugh. The nominal GDP in 1955 was $415 billion. But there's a problem with looking at big numbers. They don't make any sense out of context.
1.21 gigawatts.
So giant numbers don't really make sense until you start comparing things. So let's try that again. The nominal GDP of 1955 was $415 billion. Compare that to the nominal GDP of 1985, which was $4.2 trillion. Wow, the US economy grew 10 times bigger in 30 years? No, the nominal GDP is not adjusted for inflation. Since prices were lower back in 1955, the value of all the goods and services produced, the nominal GDP, was also lower. For example, the price of a movie ticket back in 1955 was only 50 cents. In 1985, it was $3.50. The point is, the nominal GDP in 1955 is going to be lower because prices were lower. To see if we really produce more stuff between different years, we have to adjust for inflation and look at real GDP. So let's try that again. Using base year 2009 prices, the real GDP of 1955 was $2.78 trillion. Compare that to $7.7 trillion in 1985. So, adjusting for inflation, the economy got 3 times bigger, not 10 times bigger. Well, what about unemployment? 1955 had a super low unemployment rate of about 4%. People that were willing and able to work were able to get jobs. Now, you're probably thinking 4% is not that low. It's still way higher than 0%. But don't forget that the natural rate of unemployment in the United States is somewhere between 4 to 6% unemployment.
English, Doc.
Allow me to explain. There's 3 types of unemployment: frictional, structural, and cyclical. The first one, frictional unemployment, is the idea of being between jobs. These are workers that are just entering the labor force, workers that are switching to different jobs, so people will get fired.
No, I cannot be fired. I'm fired.
The second one is called structural unemployment. This is the idea that some skills and jobs become obsolete and there's no more demand for that kind of labor. An example would be when workers are replaced by technology and robots.
Welcome to Texaco. You can trust your car to the system with the star. Check the code.
The last one is called cyclical unemployment, and this is unemployment that's caused by a recession. So if someone lost their job because the economy tanked, that's cyclical unemployment.
Mr. Strickland, it's me, sir. It's Marty. So you remember you gave me detention last week. The school burned down 6 years ago.
The first 2 types are unavoidable. Every economy is going to have frictional and structural unemployment. So the goal is not to have 0%. In fact, an economy is at full employment when we have 4 to 6% unemployment. That's called the natural rate of unemployment. Now, what about inflation? 1955 had super low inflation. It was like less than 1%. 1985 had higher inflation, about 4%, but that's way better than the stagflation of the late 1970s. An oil crisis in the 1970s caused super high prices at the same time as a stagnant, slow economy. This is called stagflation. So there's a reason why Doc and Marty wouldn't want to go back to 1975. Now let's look at 2015. Obviously, the movie got a few things wrong about the future, like flying cars and hoverboards and the newspaper industry. What's a newspaper? And also the Chicago Cubs winning the World Series.
Wait a minute. Cubs win World Series.
Sorry, Mr. Duffer. Wait, let's go back and look at that newspaper. If you zoom in, you'll notice something that would definitely affect our economy. 3 billion readers every day, our GDP per capita would just plummet. That's our GDP divided by our population. Instead of being ranked around the 15th in the world like we are now, we'd be somewhere around the 100th. In the end, it's the job of economists to look at all the different indicators like GDP growth, unemployment, and the inflation rate to find out how the economy is doing and see what it all means.
It means your future hasn't been written yet. No one's has. Your future is whatever you make it. So make it a good one.
Okay, you heard him talking about the natural unemployment rate. I don't know if that makes sense to you or not, to talk about something that's generally regarded as not a good thing, to have unemployment. Well, what's going on in our economy right now? There are pockets around the country where people can't find employees because as the economy is rebounding from the effects of the pandemic, a lot of jobs have been filled. So people aren't out there looking as much these days. So the unemployment rate, inflation, the CPI, all these things kind of cross connect and affect our buying power as individuals, what we do, what we have in our bank accounts, how we can use it, what we can do with it, and how far we can stretch it. Anybody have a question or comment about any of that? Okay, so if we just look at our little corner of the world and our income and what we can do with money, most of us are going to probably be dealing with two types of bank accounts: a checking account and a savings account. Now, checking accounts are what they call transactional, because most people these days, myself included, don't write very many checks, if any. Most of the transactions that you participate in financially are going to be done either by typically a debit card or maybe an electronic funds transfer on the internet. So there's not as much need anymore to have the paper checks. Now, there's still some people that, would rather have a paper check. So checking account, though, typically does not offer any interest because it's more of a fluid account. Money is coming and going. Savings account, though, is going to offer some kind of interest for you to earn something on your money. I don't know if anybody has a current savings account that they can remember the interest rate on. But not very much right now. The interest rate that the banks will pay you on your savings account is going to be tied to the interest rate for the federal funds rate. If banks are able to get money from the Fed at 0.25% interest, they're probably not going to pay you very much more than that because that's costing them money. So savings accounts are something that most people are going to have, but you can't expect that to be the only type of a bank account because it's not going to generate a lot of income. It's not a growth vehicle, for instance. You don't expect to grow that money. The next page of that bank accounts handout, and this is the page that you're probably going to be most interested in. If you want to figure out how much interest is being attached to your, it could be interest on a purchase that you're being charged, or it could be interest that you're earning on your accounts. And there's two different types of interest. There's simple interest and compound interest. For savings, you like to have compound interest, because the compound interest, when you earn some interest, it goes back into your account, and then the next time you earn interest, it includes your original amount plus any interest that's earned. Simple interest is just the same calculation based on the amount that you put in there to begin with. So you don't get any benefit of that interest growth in simple interest, but it's also an easy calculation. That's this I equals PRT. Interest equals principal times rate times time. So if you're gonna say borrow $3,000 for a used car, and you're going to be paying on that for, let's say, 3 years, and the interest rate is 0.06, 6% interest. How much interest are you going to end up paying? Well, the principal is the amount that you borrow. So in my example, $3,000. And it's for 3 years. And it's times the interest rate of 6%, which is 0.06. So how much is that over a 3-year period? Well, for 1 year, it's $180. So over 3 years, you're going to end up paying $480 in interest. That's 6% calculated over a 3-year period. And that is simple interest. So if you're doing some budgeting and you want to estimate how much your costs are going to be, if your $3,000 loan includes $480 in interest, now the total amount that you're borrowing is $3,480, and you divide that by the number of months, it's about $97 a month that you're going to have to pay back. So this little interest calculation here, very, very helpful. If you're doing estimating, for sure you want to know how to create this calculation. And one of the important parts down here is if the rate is 15%, then convert it to a fraction or use the decimal. So if you're not sure how to do that, probably need to brush up on that. And there will be a homework assignment on interest calculations. You may have questions about that formula. This next section is all in the blue and the red. We were talking about credit the other day. That car loan would be an example of an installment payment. Here's how you can figure out your monthly payment amount, which is just what I did. Principal plus interest, the $3,000 plus the $480. I divided by 36 months because I borrowed the money, or I wanted to borrow the money over 3 years. So that's how I came up with my monthly payment amount. The next page of this particular handout, you don't have to do this, But it is a process that you should know how to do. A lot of people, myself included, use online banking, but I also still keep a paper check register, primarily to keep track of things, to make sure I haven't forgotten something. The bank might make a mistake every once in a while, every long once in a while. So I'm not really doing that as a cross check against the bank. But, you know, if your funds are tight, if your funds are limited, you need to keep close tabs on it. And so having a check register, it's called checking account register here up at the top. That is just where you record all the transactions. And the check register is a running total. So you start off with a certain amount of money. In this case, it says beginning balance in Troy's checking account. That's what he opened it with, was $125. Then he bought some sneakers, subtracted $63. Now he's down to $62 in his account. Then he put his paycheck in for $60. Now he's back up to $122. Then he wrote a check to Paintball and wrote another check to Blaze's Books. So those come out of there. Made a withdrawal to ATM, $30, another coming out of there. Then you add back in the next paycheck. So the check register is this constantly fluctuating balance amount. And it used to be that checks would take, 5 to 7 business days to clear. Nowadays, if you use your debit card and you check, within a half hour, that transaction, especially if you look at it online, that transaction is already showing up as pending in your checking account. So however you choose to keep track of your money, things are going more and more towards electronic monitoring, online apps, phone apps, that sort of thing. That balance that you see in your app is good for everything that is already what they call cleared. It's a transaction that has been paid. But what if you wrote a check that you sent to somebody in another country and it takes them 2 or 3 weeks to cash the check? Okay, you better make sure that you got that written down somewhere, or that you remember it, because now your balance in your account is not accurate, because you still have something else, another transaction out there that's going to clear. So that's one of the reasons why I'd like to keep a paper record also, is because that allows me to say, okay, these 10 things have cleared, but I got 2 that are still outstanding. So I can't go spend that money again. It's already spoken for. And when I keep track of it, that keeps me hopefully from having a deficit. Because what happens when your checking account is overdrawn? What's the bank do? Yeah, and overdraft fees are $35 sometimes. Plus, if you wrote that check to a business, they might have a fee that they attach to that also. And now you're going further in the hole. So does anybody know or can think of a way to protect yourself from those high overdraft fees? I mean, obviously, don't get them in the first place if you can. Have you heard of overdraft protection?
I think maybe like they have seen when it's paid by monthly. It is like it is the bank. It's like amount, let's say $300 every week or month. Every week says $800. It has to be your account, or it is like that's or like that.
No, it's. I think what you're talking about is a minimum balance.
Yeah, but sometimes you're gonna pay it's not. You're gonna pay like the fee by the month. It's like $2.99 or $3 or $5 by month.
Yeah, there are,
That way, they're not gonna charge you if your account is $4.
if your account goes too low, they will, some banks will charge you fees on that. And that's what I mean. They're going to tell you, you have to keep a certain amount in that account or they charge you fees.
Yeah.
It's different than what I'm referring to as overdraft protection. Yeah, Brianna.
But my bank gives us 24 hours to get money back in.
24 hours to make sure that you cover that expense. That's one way that it's a type of overdraft protection. Anybody else out there have anything like that? There are a couple of other ways that you can get overdraft protection. You can have your checking account linked to your savings account. So if you do make a mistake or you forget something and it turns out that that there's not enough money in your checking account, the bank will take the money to make it up out of your savings and cover that cost. Now they're still going to collect a fee from you because they still have to do that, but it might only be $6 instead of $35. So it's money. It's a good setup to have that. Or if you have it connected to a credit card where you can get like a cash advance, that's not really a good way to do it because, like we talked about Tuesday, if you get cash advance from a credit card, it's a loan. They're going to charge you interest. So linking it to your savings account is probably the most efficient way to make sure that at least if it happens, you're not getting hammered with a lot of heavy costs. Yeah, Brianna.
Also, I could be wrong, but I believe since like my account's kind of like attached to my parents, so like if I go over, it'll take the money out of their account instead of charging us.
That could be. I mean, it all depends on how the setup occurs at the bank. If they're co-signers on the account, for instance, yeah, that would make sense. Are you 18?
Yeah, but we made the account.
Okay, yeah. And for a lot of minors and younger people, that's pretty common, because you don't want to turn somebody that's 12 years old loose with a checkbook, and an account. They think you can just go write checks and do whatever. It gives families a way to monitor and help people along to learn how to work with the system.
Yeah. So there's check and register and statement are the same.
Check register and what?
And statement. Bank statement
No.
are the same or different?
No, the check register would actually be, it's if you have a checkbook with checks in it, then there's another part of that is actually in your checkbook. The statements only come out once a month. A statement comes out as a summary. It's going to list all the transactions for the whole month. So, I mean, you can wait for that if you want to reconcile everything. But I've never been in a position where I feel like I'm floating in money, so I don't want to wait. I have to make sure I keep track of stuff. And so I watch it pretty closely. And the online banking that's available now makes that really easy. So, and that little extra piece in your checkbook might look something like this with a bunch of lines. Credit and debit and balance. Credit is how much you put in. Debit is what you take out. And in case you haven't seen one, this is an actual paper check. If you're setting up some online transactions, the most important things on this paper check are right here at the bottom in red and in purple. That ABA routing number. Anybody know what that stands for? What? ABA routing number. It's at the lower left-hand corner.
Is routing number?
Yeah, does anybody know what that stands for? What that used for?
Or for a specific the bank.
Yeah, exactly, Ruth. Every bank has an identifier, a numerical identifier. So this, I mean, this is a fake one, obviously. It just says 1, 2, 3, 4, 5, 6, 7, 8, 9. But if you're setting up transactions outside of your account, somebody like if your job wants to do only direct deposit on your paychecks, they're going to ask you for the routing number, which tells them which specific bank and tells everybody on the system what bank the money is going to. And then the second number, the account number, is your specific account. If it goes to your employer, yeah, that means you should protect that. You want to be sure that it's not just given out willy-nilly. But you know, most employers don't want to deal with paper checks anymore for paychecks. You know, electronic deposit is much easier, much more efficient. It's cheaper. You don't have a lot of paper to produce. People lose checks. You know, I like it because, you know, the money goes in at midnight the day of payday. So I wake up in the morning and, you know, your paycheck is already there. And most companies work that way with electronic deposit. So the routing number is on, even if you don't have paper checks like this, it will be shown in your online account. If you have an online app for your bank, the routing number and your account number are going to be on there. Questions on any of that so far? Okay, I got something here to add that's a little bit more detail on the check register. If we were in class all together, we would be doing all this, filling all these in. And this just gives you an idea about what somebody has maybe created for themselves. The thing about the checking balance, you always have a new balance every time there's a transaction. So whatever your starting balance is, in this case, the example says $347.95. So you open the account, Gustava, open the account with that paycheck. So that's the starting balance. Then you take away the auto clinic, take away the builder's check. Each time you have a transaction, you're going to write a new balance number out here in this column. And so if you want to practice with these, that's what these examples are here for. The third part of this has a blank check register and a bunch of different transactions. So it's not a homework assignment, but could be for anybody that's never done it before, could be good practice. If you want to figure out how to make sure that you're keeping track of that balance correctly. That'll keep you out of trouble with overdraft fees for sure. Okay, the next piece, maybe I should have done this one first, but it's actually about writing checks. You may never have to worry about this, but the thing that's different about writing checks is these numbers that you see up here, $10.91, $7.62, $228. You actually have to write those dollar amounts out in words on your check. So if you look at this number 7, this Marie Servas, of course, at the very top is the date. Right underneath that, it says pay to the order of. Well, that's who you're giving the check to. In that example, it would be Hartman Dental Clinic. Over here to the right, you're going to write $86.97 in the numbers. That's only enough room to do the numbers. And then down below this, and it's a unique kind of way of writing, because now you have to use the word and where the decimal goes, and you're not saying cents. It's not going to use CENTS. It's not going to say cents on here anywhere, because you're going to have to write 86 and 97 100ths dollars. Because the word and goes where the decimal goes. Of course, we know that 97 to the right of the decimal is the cents part. The number to the left of the decimal is the dollars part. So why would it say 97 100ths? Well, that's 97 cents out of 100. You write it like a fraction. And for me, if I don't fill up the whole line, I'll do a squiggly line or something like that so that nobody else can write anything else in there. I fill it in some way or another. Down in the corner here, Bank of Camden, it says memo. What would you put there maybe?
Eden, why you write that check? For example, sitting job in my case, I pay my worker for sitting job.
Yeah.
Right there.
Very good, Ruth. The example says it was for an office visit, so maybe you write office visit. You know who it is. It's the dental clinic. Maybe it was for braces. Maybe it was for, cavity repair or something like that. The little memo down there is just a spot on the check to help you remember what it actually was about, why you paid them. For a lot of banks these days, they offer these carbonless copy checks. So it used to be they would collect all your paper checks and then they'd send them back to you at the end of the month along with your statement. Well, now when you write somebody a paper check, it just gets scanned electronically and you can see it online. They don't return any of that to you. So your copy in your checkbook, this can be helpful, especially if you have expenses that might be tax deductible. Childcare, for instance, maybe you can deduct that off your taxes, or you got some business expense. Those kind of things are good wording examples to put down there in that memo section. So the checks themselves are pretty straightforward. I mean, there's not much to them. Questions or comments, anybody? Okay, so the last thing we're going to look at here for banking involves statements. Mentioned that a little bit earlier. This is the sort of the monthly summary, the monthly recap of all the transactions that have occurred on the account for the month. Most banks will give you the option of paperless statements, which I would recommend, because who wants all that paper laying around? You've got the same bank account for years and years, that could really pile up. But you don't need to really keep any of this stuff for more than 7 years for tax purposes anyway. So if you got things that are older than that, you need to take them and run them through a shredder. Don't just throw those financial records into the trash, because there are scammers out there that look through the trash. And if they can find your account number and information like that, you could become a victim of fraud. So get the paperless statements. That way you can access it online. Even if you even need to, I don't hardly ever look at my statements. I get a notification by email every month that the statement is ready to review. But because I use the phone app and I'm in it, every 2 or 3 days, unless I got a question about something or forgot something that the statement can help me remember, I don't worry about it. And which is another reason to have the bank keep the paperless process going, because then all it is a PDF file that you can access anytime you want to, and they're keeping it. You don't have to worry about it. So this is a little bit kind of an old school sort of way to manage your checking account with the statement that comes once a month. You go in there and you're trying to balance your checkbook. It can drive people crazy because you can be off a little calculation by a few cents and not come back to the correct balance. And so one way to do that, there's a couple different things to consider here. Balances are the sum of all the transactions, whether it's a plus or a minus. You have a beginning balance. This column here in this first table shows you the deposits. Then you have withdrawals, whatever the source, whether it's an ATM or a check or an electronic transfer, plus any service charges. That's a minus also. You can do it that way where you can summarize things. So the second little table down here shows you a part of this person's bank statement. Her previous balance was $286.91. This is a representative way to do some grouping. Remember from algebra or from arithmetic, we can group items together if we're just adding and subtracting. If we can group all the pluses together and add them up, we can group all the minuses together, add them up, remembering that they're actually negatives. And so this first box here, checks and other charges, those are all going to be minuses. But we can still add them up to get a total of how much we got to subtract. Then deposits work the opposite way. You can still summarize them, add them together. That's how much on the plus side you got. So her total of the checks and other charges and this is somebody who doesn't have a lot of transactions, obviously. Her total of transactions with checks and other charges was $250.05. $250.05. So how much were her deposits and credits? $464 plus $148.90 plus $45.21. Her deposits were $658.11. She started off with $286.91. So is her balance increased or decreased? It's gone up. Yeah, she had $658.11 in deposits and only $250.05 in withdrawals or charges. So what is her new balance? $945.02 when I add deposits together. Subtract the $250.05. Now our balance is $694.97 at the end of that month. So her balance has gone up by over $400. So if you ever want to get more practice doing this kind of stuff, that's what number 6 and number 7 are both about. Now, the one thing that might be kind of odd here, if you look at number 7 where it shows that under deposits and credits, we've got a 188.42 with a minus sign next to it. What is that? It's what? Yeah, not if it's under the deposits and credit section. I don't know for certain, but I think that's a bank mistake that's being corrected. Or maybe something like that has occurred where they accidentally took money out of your account and should have taken it out of somebody else's. Think back to when you're doing combining negatives, multiplying negatives, you get a positive number. So a credit like this actually cancels out something else, or maybe they put money in your account that they shouldn't have. So you don't see that hardly ever. You're gonna see more traditional pluses and minuses because most of us, we're not accountants. We don't speak in those kind of language terms. We don't talk about debits and credits like accountants do. We just have deposits and we have withdrawals. So while we're still on the topic of banking and types of accounts, there are different types of savings accounts that might work in your favor a little better than just a traditional savings account. And this saving and investing handout covers that under this practical money skills. A passbook account is just a traditional, very low interest rate savings account. And literally that used to come in with a little bitty book that you would, hey, they put a stamp in with the amount every time you come and made a deposit. Those you might find in your grandmother's old records somewhere. Nobody uses those anymore. Most savings accounts are going to be statement accounts. You're going to get a statement. You can still access those with ATMs also, as well as your checking account. Some banks will give you an interest earning checking account, but that's where you're probably going to have to keep a minimum balance of maybe $500 or $1,000 or something like that. And you're going to earn a little bit of interest. Then you get into savings accounts. Lost it. Then you get into different types of savings accounts. First example that they show here is called money market deposit accounts. Pay you a little bit better return, a little bit more interest. You do have immediate access to your money. It usually requires some minimum balances, and those are going to be higher than they would be for a typical checking account, an interest-bearing checking account, because the bank's going to pay you a little bit better return. They're going to pay you a little bit higher interest because they're doing some investing with your money while it's in there, and they don't want you coming in and asking for all of it to be removed at the time because you're getting interest. They need to know that they have it there to be able to generate income that they can then share with you through this money market account. Is it enough interest to do it? It's better than a regular savings account. And like a lot of stuff, the more money you have, the better these kind of deals are for you. So people that don't have a lot of money, this isn't really going to help them, because can you keep $1,000 or $2,500 in your savings account and not have to do anything with it, not worry about it, not need it for something else? I don't know. But if it's money you don't have to spend for, 3 years or 5 years, yeah, it's a better deal. And you see that's built on the second bullet here, on a complex structure that varies with size of the balance and current level of market interest rates. Very unpredictable. It's all done through the bank analysis. You could also get CDs, certificates of deposit. The problem with CDs is you lose that money, that you lose the use of that money for however long the CD is. So if you get a 12-month CD, you're stuck with it. Well, why does the bank do that? Well, same reason on the money market. They want to know that money's there for them to invest. So they're going to pay you a little bit higher interest rate, but you can't touch it. If you come and break the CD before the expiration of it, you're going to pay a penalty. You're going to have some fees to pay. And there's a bunch of different types of CDs. I won't worry about those, but the big thing is that you've got restricted access to your money, and you've got a withdrawal penalty if you cash it out before the expiration date. And in the parentheses here, it says penalty might be higher than the interest earned. So all that time that you let them tie up your money, and all of a sudden you need it and you break the CD, and now you're going to pay more in fees than you would have earned in interest anyway. It's okay if you don't have to worry about needing the money. CDs are good for the average person. Here's another section that talks about how interest is calculated, and it gives you the difference between simple interest and compound interest. This first one is just the principal times rate times time. You've got a little bit more calculating to do for the compound interest, because now you have to add the interest that you've earned back in. And so your starting balance, as it were, is going to be different every time you do that calculation. We want the compounded interest. And so if you hear banks talk about interest compounded daily, they're saying that to try to encourage people to come and invest with them, get those savings accounts in their bank. So there's a bunch more stuff in there it's really good information to look at for different types of savings accounts. So the last thing we're going to look at here, and that's not the one I wanted first. Types of insurance. Why do we need insurance? In case something happens, right? Insurance is all about risk. Just think about all the insurance companies that advertise on television, on the internet. You could probably name 5 right now just based on their advertising people. Like, who does Flo work for? Progressive. How about the Discount Double Check? Or Jake, who's he work for? Jake from State Farm. What about the Lizard? What insurance company does he represent? Geico. All of those companies and many, many more. You thought you were paying for this, but what you actually got was that Farmers Insurance. They're all out there. They want your money, and they make money by investing it so that they can be in a good position to pay a claim when you have a loss. Because that's what insurance is there for, is to cover incidents of loss. Homeowners insurance, you can't buy a house with a mortgage without having homeowners insurance. The bank won't let you. Because if the house burns down, the bank wants to know that they're going to get paid, and you want to know that you can rebuild the house. So the homeowners insurance is essential. If you're just renting an apartment, you ought to look at getting renter's insurance. It's not that expensive. Why would you want renter's insurance? You don't own the property. You don't care if the place burns down, do you? Well, yeah, you probably do, because your stuff's in there. What if you're in an apartment building and the people up above you leave the water running overnight and it floods out your apartment? Yeah, it's not your fault. I mean, renter's insurance is really very, very cheap, you know, for say $5,000 worth of coverage. Most people in an apartment don't have a lot of stuff. You know, it's not like a house that you can fill up the garage and the basement and everything else. So renter's insurance is a good investment. Not that expensive. And if you do have a loss, then there's a way to take care of that. Can anybody think of other types of insurance? In general. Car insurance, yeah. Car insurance, if you drive, Indiana law requires that you have car insurance.
Life insurance.
What's that?
Life insurance.
Life insurance, yeah, that's another good one. Especially if you're the main breadwinner in your family, and if something happened to you, what's going to happen to your family? That's what life insurance is there for, to take care of the people that are left behind. So car insurance, life insurance, property insurance, traveling insurance. Okay, yeah. It doesn't always pay off to have the travel insurance. If, you know, I had some stuff that I was going to take a trip on last year, and the pandemic was an exception. They wouldn't reimburse me. They wouldn't pay out a claim because they said it was like an act of God sort of thing. So travel insurance is good. If some specific reason occurs that you can't make the trip, you get your money back. And any of these types of insurance are going to have very specific requirements. Have you heard of liability insurance? We talked about liability in the context of businesses. They got to have liability insurance. Your homeowner's insurance is going to have a section on liability. And if you look at these examples here that I've got up on the screen, that third one down, my neighbor injured his back while walking up my icy driveway. Okay, well, you're responsible to make your driveway safe, and the neighbor's probably going to file a claim that your insurance is going to have to pay, because they're going to say you were liable, you didn't get out there and shovel your driveway or put salt on it or make it safe or whatever. But that's what insurance is there for. What about medical insurance? It's another requirement. Everybody's got to have medical insurance. See another good example. Further down the list here, it says, I teach kindergarten, but I had a severe eye infection and have gone blind. What kind of insurance might help you with that? It's related to work, obviously, because now she's not going to be able to teach. She's a kindergarten teacher. She can't probably, unless she teaches in a blind school, I suppose, but she's going to have to get re-educated. Health insurance would cover the medical costs, but what about the loss of income? It's called disability insurance. Think of the Aflac duck. That's what they promote. They're trying to provide that kind of supplemental insurance that sort of helps fill the gaps. And disability insurance a lot of times is offered through an employer. Short-term disability, 30 days or less. Long-term disability usually kicks in after that. So disability insurance is another type of insurance. There's one thing that all these types of insurance have in common. Well, several things. They're all based on numbers. Insurance companies crunch the numbers and all their rates are based on statistics. So I'm a white male of a certain age. I fall into a certain category. And so they're going to base the cost that they charge me on that category. A 16-year-old just getting a driver's license is going to pay a much higher car insurance premium than I would, being much older and more experienced, because the risk of that 16-year-old having an accident is much higher than it would be for someone who's more experienced. It's all based on the numbers. Can you think of anything else that all types of insurance have in common? What about the timing of having the insurance? When do you need the insurance? Brittany says now. Before a loss, right? You can't go break your leg and then the next day go get medical insurance and then hope that they're going to pay for your broken leg that happened before you were insured. There's no way. So a lot of it is about timing. You gotta have these things in place before you need them. Medical insurance before your wife has a baby, for instance. Disability insurance before you get injured on the job, all that kind of stuff. So insurance industry is a booming industry because they have access to a tremendous amount of capital from all the people that are paying their premiums every month or every 6 months or whatever. And they invest that. They invest large sums of money in the stock market, and that allows them to stay in business and still pay out claims when people do have losses. And the statistics part of that is it's kind of like gambling in a way, because they're basing how much they're charging you on the likelihood of some loss occurring, but they've got enough examples and enough history where they can be pretty accurate with all that. And you can be an actuary. It's called, and that's the job that you would have if you work for an insurance company, and that's all you did was look at situations, look at statistics, help the insurance company come up with their rates. That's an actuarial position. If you like numbers, could be a good job for you. If you're good at sales, life insurance and other insurance salesmen can make a really good living. Anybody have questions? Covered a lot of territory today.
No.
All right, that's all I got for today, guys. So thanks for coming on the Zoom and participating. We'll see everybody on Tuesday.